Hello, a very good evening, everyone, and thanks for joining us in this webinar this evening or this morning, depending on where you are from the world. All right, so my name is Richard, and I am your host today. I'm one of the co-founder of Wealth and Joy, as well as a committee member of OTCS or Online Traders Club Singapore. So if you would like to find out and keep in touch with our events and webinars, please join our Telegram channel by searching for Online Traders Club or Wealth and Joy in Telegram, and then join both channels so that you can be kept posted of our upcoming events. All right, so let me get started. Now, yes, so for those who are here for the very first time, Wealth and Joy is an online community where we share wealth building, education, and opportunities under one roof. So, to be kept posted, just join our Telegram channel by searching for Wealth and Joy. As for OTCS or Online Traders Club Singapore, we are a non-profit society formed in 2005, and we are a community of traders and investors, and we are run by a group of volunteers. And to me, OTCS stands for a place where we network, share, and learn, and we do it through a series of workshops, courses, and our library. And for webinars and workshops, we aim to have about 10 to 12 a year. It is free for our members to attend. But since the COVID hit, we have gone entirely online and we make it free for everyone to attend worldwide anytime. And this photo is a precious photo that is one of the last physical event that we held at the Singapore Stocks Exchange Auditorium, and it was very well attended. And hopefully, with the COVID situation improving, we will be able to have some physical events in the months to come. All right, so we're looking forward to that. As for courses, we aim to have about 3 to 6 a year, and normally we will do a group buy with the trainers to secure a better price for our members. As for our library, we have about over $6,000 worth of resources, and it is a physical library with books and as well as CDs and DVDs. But because of COVID, our physical library is closed. So we will be, so therefore, I think we will only look into this again after the COVID situation has improved. Okay, so again, OTCS to me is a place where we network, share, and learn, and we do it through a series of workshops, courses, and our library. And to find out how much it costs to become our member, it is 120 Sing dollars a year, and for a limited time only, it is $60 a year. And because of COVID, it is now entirely free for all. Okay, so to be kept posted of our events and webinars, please join our Telegram channel by searching for Online Traders Club, or you can also join our mailing list by going to our website. And at this juncture, I'd like to give a shout out to our OTCS crew. They are also our fellow members and who are helping us behind the scenes to run our physical events. And they are our unsung hero. And I'd like to take this opportunity to thank them for helping us out. Okay, so this is a very important slide. It is the disclaimer, and I'll need to read this. Okay, so you are responsible for your own profits and losses. The speaker's opinions are their own and does not represent OTCS opinions. OTCS is office holders, associates, sponsors are not responsible nor liable for your losses. OTCS events are for educational purposes only and should not be construed as advice. And when you're in doubt, please seek professional help. Okay, so now we come to tonight's topic, and that is how to backtest and refine option strategies in just a few clicks. And as you know, I believe many of you here are watching us live on YouTube recording. You will probably be trading options. And sometimes you'll be wondering, would the option strategies that we are trading, is it able to stand the test of time? Or we are wondering, how would it have behaved over certain periods, such as over the COVID crash or other market correction periods that we have experienced in the past few years, right? So then wouldn't it be nice if we are able to backtest it in just a few clicks without programming? Now, there might be other backtesting services available out there, but most of them, if not all of them, are using end of day data. And using end of day data is not the best way to backtest option strategies because option prices can move quite drastically intraday. And the ideal way to backtest option strategy is actually to use intraday data. Okay, so tonight we're going to be witnessing for the very first time the backtesting, semi-automated backtesting of option strategies using intraday data. Now, in the marketing material for the webinar, we have written that this backtester is using 5-minute intraday data. And the good news is that today we are going to witness the backtesting being done in not 5-minute data, but 1-minute data. So the backtesting results will be even more precise with a 1-minute data. Okay, so without further ado, let me now hand over to the co-founder of OptionOmega, Troy, to share with us more. Troy.
Good evening.
Oh,
Thanks for having me. Can you hear me?
yes, can hear and see you. You can take
Okay,
the screen. Yeah.
share my screen.
Yep.
Well, thank you so much for
And
having us.
for the screen to load, it is still loading.
Okay,
Okay, I'm
let me know.
testing options. Now, Troy,
Okay,
before you start with the slides, maybe you can share with us a little bit about yourself, your option trading journey, and how this project or this company came about.
sure. Yeah, I'd be happy to. It's not me by any means. There's three of us, and one of my partners, Rusty, will be here with us and being able to answer some questions and things like that. And then our other partner, Matt, is actually watching right now. But a quick little thing about me: I've been trading options for about 4.5 years now, and quickly fell in love with them. I started basically from, for those who are familiar with options, kind of from a tail risk side of it. So I wasn't trying to collect premium as much as hedge against black swan events. And as I got more and more into it, I realized there's a lot more you can do with it. I was come from a software engineering background, and Rusty was actually my boss at our former employer. And we both, when COVID came, we both started kind of evaluating life and thought we want to do something different. And so we, along with Matt, our friend and partner, started the idea of testing different option strategies, trading strategies. And along the way, we ran into some hiccups with the back testers that were out there. And the hiccup was it was not true to what we were seeing in our P&L. And so we started a journey of trying to figure out, crack the code of, is there a way to test strategies using better data? And that journey has led us to OptionOmega. And so that's where we are today.
I see. That's very cool. So let us now begin with your sharing with us more about
Oh,
Option Omega and the kind of problem it solve, and maybe give us a demo and walkthrough of the website.
sounds great. So I'm going to just do 7 or 8 slides real quick. And if you are at all familiar with options, this will be, this is something but just in case you didn't know who the audience, if you're not familiar with options, we're going to do just a quick little recap of what options are, and then some of the why you'd want to test them, and then some of the problems with testing. So what is an option? Options are financial derivatives that give buyers the right, but not the obligation, to buy or sell an underlying asset, and an agreed upon price and date. That's a very stuffy definition to just say that options were created really for hedging purposes. They were created to, if you are short stock, to be able to get out of that. If you're long stock, to be able to get out of that. But they have quickly blown up. Last year was the biggest year ever for options. I imagine this year will be even bigger because there are so many different things you can do with them. And there's a couple reasons why you should trade options. Again, I say you should. Options involve risk. You're not suitable for all investors. And as was so eloquently stated before, when in doubt, check with a financial advisor. This is advice. It's not investment advice. It's just an opinion. But why should you consider options? First off, they offer neutrality. They are one of the few financial instruments in the world where you can profit from not doing anything, from the underlying not moving at all. That's pretty unique. When you buy a stock, what do you want it to do? You want it to go up. What you don't want it to do is go down. And what gets very depressing is when it doesn't do anything. With options, you can create spreads and strategies that profit precisely from it doing nothing. You can also create different time horizon strategies. So you might be long in the short term while short in the long term, right? You might be long from a month perspective and short from a year perspective, or vice versa. You might be short from a month perspective, but long in the long perspective. And for most S&P buyers, probably in the market right now, that second option might seem like a pretty good option. Short in the short term while long in the long term. Options give you the ability to create strategies that do both of those things at once. They also give you the ability to create arbitrage opportunities in very specific instances. And so you can create strategies that focus on movement. Again, delta in the similar way of stock, it could be a stock replacement. You can profit or lose from velocity of movement, how fast that movement is taking place. You can profit from, be completely neutral on movement, but profit or lose from the volatility of a position. You can, as we stated earlier, have different time horizons. So you can target a specific time frame for your strategy. If you think an underlying is going to do something in a specific amount of time, you can create a very specific strategy for that. And then probably what will become more and more important over time in this environment is you can create arbitrage opportunities and options using interest rates. So you can target specific interest rate changes in the options. You can use all of these together. You can use all of them specifically. So options give you an extremely powerful way to create very, very different types of strategies. Now, those are very complex strategies, obviously, very much more complex than just buying a couple shares of a stock. So how do you know if you're doing the right thing? How do you know if the strategy that you created is going to be profitable in the long run? Well, you probably need to backtest that strategy. And what backtesting allows you to do is see how a strategy has performed historically or may perform in the future, including key metrics from the past decade, such as the win rate, the max loss, and the profit per trade. Because options expire, you can run these over and over and over again. Well, what happens when you run these over and over and over again is you start to have a data set historically of what would have happened if you would have put this specific strategy on. And backtesting allows you to change that a little bit, to analyze specific strategies, to adjust the trade specifications of that strategy, to adjust the deltas of it, the days to expiration of it. You can add management parameters to it. You can say, I want to get out at this stop loss. I want to take profits at this %. And you can run historical data to see what would have happened when you change those parameters. So backtesting options is very, very useful when you're creating strategies that you want to run throughout time. But there are some pitfalls to backtesting. Most option backtesters use end-of-day data. And just a quick story of why we figured this out. Rusty and I started backtesting option strategies because we wanted to kind of increase our profit, increase the amount of capital that we were using per trade. And so we started backtesting options. Well, we found a strategy that was amazing. We were going to be zillionaires in just a matter of years. And then something strange happened. When we ran this strategy in real life, it was terrible. It was a complete loser. Well, why was that the case? Well, what we realized in retrospect was that this backtester was using end of day data. What is end of day data? Well, what they do is when you're running a strategy, they will open and close all positions in that test at 3:50 p.m. So if you say, I'm going to put on a 2-day out option, I'm going to buy a call, that day it runs it. It will run it at 3:50 p.m. Whatever the price was at 3:50 p.m. the day that you said, I want to start this test, is what the price is going to be. Now that is fine for longer term option strategies. If you are running leaps 365, or over 600 days away or something like that, that can be almost fine. But end of day data almost becomes useless for shorter duration trades. And I'll just give you 2 quick examples of that. So you don't have to go back far to see a day where this would have been troublesome. This is a chart. Now this is using market profile. Don't let the letters scare you. But May 12th, so last week, I believe it was last Thursday, ES futures opened at 38.97 and they closed at 39.27, right? The 30-point range. So if you had a position on using an end of day backtester, that backtester from one day to the next would have saw a 30-point range. They would have, so if you have a larger strategy on with quite a big tent of profitability, no harm, no foul. That was completely fine. Just a 30-point day. That's in this volatile environment, that's great. Not a lot of movement, especially if you're trying to run a neutral strategy. The reality, however, is that the day oscillated between 38.54 to a high of 39.61. It actually had a 107-point intraday range. If you were running any type of shorter term option strategy, you would have massively been affected by this range. Your P&L would show you what the end of day backtester is not showing you, that no, I probably got stopped out. And that's the problem with end of day data. It won't show the stop outs because it's looking from 3:50 p.m. to 3:50 p.m. Well, if you have a 3-day trade on, you probably got stopped out that day one way or another, or you probably wanted to take profit one way or another. But the test did not show you that, which is a big problem when trying to create tests that you want to model for the future based on history. One more example. SPX, I believe it was starting this week, SPX now has 5 expirations a week. So because most backtesters use end of day data, they're unable to test strategies that last for less than 1 day. So most backtesters only allow you to trade 1 day or greater expirations. You can't trade same day expirations. But again, with the addition of Tuesday and Thursday expirations now in SPX, there's a huge opportunity to use same day expiries in building out strategies. You can run 0-day strategies 5 days a week if you wanted to now. Well, most backtesters are not going to allow you to build out any type of a model or portfolio because of their limited data use. So this is why we created OptionOmega. We use 1-minute data, which we believe provides the most precise backtesting capabilities in the world, honestly, especially for shorter term data, especially for intraday 0-day data. And so what I'd like to do right now, if it's okay, is just show you the app, and we can maybe go through some different case points, how to build out a strategy, how to build out a test, and then go from there. So can you see my screen?
Yes.
Okay, perfect. So this is our dashboard in OptionOmega. And as you can see, I have some saved tests. Let's click on one of those real quick just to show you. So if you're familiar with options, this is an iron condor. And I will show you how we built this out in just a second, but I wanted to go through some of these metrics. When you run a test, we will show you the dates that you ran this. We go back to 2013. we'll show you the option legs that you built this test with. So in this case, and we'll just go through it real quick, you are selling a 16 delta put with 10 days to expiration. You're buying a put 10 points below that. So this is a 10-point wide iron condor. You're selling a call, a 10 delta call with 10 days to expiration, and you're buying a call 10 points out with 10 days to expiration. We then give you the entry conditions to which you created this. And again, we'll show you how to do this in just a second. You open the trade at 9:45 each day, and you allocate 20% of your portfolio, but you actually override that by saying you're only going to trade one contract per trade. That's important for testing, and we'll show you why here in a little bit. Your exit condition is you're going to exit at a 10% profit target and exit at a 12% stop loss. Your P&L in this trade, again, this is backward looking, not forward looking, but theoretically, historically, your P&L using one contract at a time would have been $3,100. But what's more important than that, and this is important for running tests, is these metrics, because as we'll show you here in a second, as you change your allocation, your P&L can greatly go up and down. But the win percentage, when you're starting to build out a strategy, using one contract at a time often gives you a better view of what the actual mechanics were. So you win 59.1% of the time. This is a premium capture rate. So what does this mean? What it means is this is how much premium you sold. So in an iron condor over 4 years, you sold $217,000 worth of premium, and you captured, or you got to keep 1.4% of that premium. This was your starting capital and your ending capital. This is the max funds you had through time and the minimum amount of funds through time. These are the amount of trades you had and the winners you had. And then we give you some averages. This was, you averaged $3 per trade. Your average winner was 26. Your average loser was 31. Your max winner was 230. Your max loser was 31. And your average days in trade are under 1. So you're averaging 1 day per trade on this. We then give you a trade log and show you how we opened up each one and when you got stopped out and things like that. So, and remember, this is important when you're comparing this to end of day data specifically. So we tell you when you opened this, you opened at 9:45 a.m. You told us to, and we did it. We give you the opening price of the underlying. We give you the specific option legs that you sold or bought in that trade. We give you the premium that you collected for that. We give you the closing price on the underlying when it was closed out. And we give you, and this is, we're very proud of it, and we think it just leads to very precise tests, is we actually give you down to the minute when you were stopped out or when you took profit. So in this case, you put this on Tuesday, January 2nd at 9:45. Well, about 45 minutes later, you were stopped out from your price target, from your stop loss. That's fine. So as you go through this, you can scroll through these in time and see where it happened. If you have a big set of losers, you can go through and see what dates were that, what was it, and you can actually compare it to the market. You can go back and look at a chart and say, what was happening that day? So let's make some changes in this just to show you how this works. When you are at a test and you click new backtest, we actually load everything for you from this test just so you can make quick changes. So we go back to 2013, our data. You can do different ones. We have some kind of easy setups for you. So we have COVID crash, last 2 years, last year. When you click this, you'll go to yesterday's range. For this sake, let's do year to date. And let's say we want to take off the call side. We just want to sell the put spread. How that worked this year. We'll keep the entry time the same. The frequency is the same. We're going to do this every day. We're going to use 10 days to expiration, but that doesn't really matter to us, just the closest contract to 10 days. If you don't want to do that, if you say, I only want to trade 10 days to expiration, you can click this button, use the ZAG DTE, and we will say we're not going to open it unless there's a 10-day to expiration contract. We also use, I forgot to mention this, our two tickers that we have right now are SPX and SPY. And we haven't made an announcement to anyone, but you guys are the first to hear. We are aiming to add IWM and QQQ very soon. The date, we don't know yet, but we're working on that. But right now we have SPX and SPY. And to continue down here, these are your starting funds. How much money do you want to start with? And this is your allocation per trade. Now, as I said before, we hijacked that a little bit and overrode it by putting one contract per trade, just so we could see the mechanics. But now that we've seen the mechanics, let's change that with a put spread. We're just going to do the put spread now, and we're actually going to allocate 10% of our portfolio to it. You can actually have max open trades, because as this grows, as your account grows through time, if you're continually using 10% allocation, obviously you're going to be putting more and more contracts on. That would be a great problem to have, because that means you haven't blown up your account. But for this purpose, we're going to say the max we ever want to open is 100 of these at one time. We're going to keep our profit target the same and stop loss. And then we have some specific indicators that we use. And you can open a trade based on the VIX. You can open a trade using technical indicators. So we have RSI and then SMA. And then we also have squeeze metrics. If you're not familiar with squeeze metrics, you can look that up. But we have some squeeze metrics indicators that you can test.
Real quick.
Yes.
Troy, would you, I think you meant to put 100 into max contracts per trade and not max open trades.
Oh, I did. Yeah, that's right. Thank you. That's Rusty. And Rusty is awesome. So we'll go down there, and then your exit conditions can be the same. So you can exit based on VIX. Say, I want to, I never want to put this, I always want to get out if the VIX goes over 40. Or I want to get out if the VIX goes under 20. A similar way, you can do that with the entry conditions. I only want to enter this if it's under 20 or over 40 or whatever. And then we have some miscellaneous things. And Rusty, actually, if you want to hop back on, do you want to go through each one of these real quick? Because these are small things that you might not think make a difference, but they do make a difference. So this right here is, yeah, go ahead, Rusty.
You want me to go ahead and speak? So this is pretty self-explanatory, but because this varies per brokerage and per locale, we allow you to put both the opening and closing commissions and fees into different boxes. Again, this is to simulate as closely as possible to the real world. A good example for this would be SPX versus SPY. Because SPY is 1/10 SPX generally, you will find that as you scale up your account, a lot more of your profits will go towards commissions and fees. And so we think this is very important, especially for SPY. And then if we add IWM and QQQ, the same thing. So then the next field is slippage. If you're not familiar with slippage, it's simply in the real world, you very rarely will get filled at the midpoint. You usually will find some slippage, again, depending upon the underlying asset. Thankfully, both SPY and SPX are very liquid, but also in times of, if you are buying and selling leaps, those are far enough out in time that you will probably have more slippage on the entry. And so usually, for example, for SPX, I personally model maybe 5 cents on entry slippage and 10 to 15 cents on exit slippage, but it depends on your strategy. If you're doing 0-day trading, 0 DTE, you will probably have a higher exit slippage. So that is the slippage. And one more final point about that. For entry slippage is pretty simple, but for exit slippage, the way it works on a loss is that we simply deduct, we simply add more to the loss. So if you had a 10 cent slippage, and you were stopped out, we would add 10 cents past your stop out. But for in profit take, if you've ever traded spreads or calendars, especially, you will watch the midpoint bounce around, and then usually it will it will require the midpoint to be a certain distance away, and that's what the slippage would be used for, and the exit there for profit takes. So then the next one is that we flag any trades with a wide bid-ask spread. And a bid-ask spread is simply the difference between the bid and the ask on a certain option. And if we determine on our algorithm that on a certain day or a certain time when it was opening or closing, that this was wider than our tolerance, then we will flag that, and you can ignore those trades to keep this more accurate. The next flag is if you are running this tester with long-running trades, let's say you're testing a 60 or a 90 DTE strategy, and the test ends, well, you might have a bunch of open positions, and some people want to say, well, just close them all at the end of the test so I know what the profit would have been if I just closed my whole book at the very end. And then cap non-opening profits at profit target. It's a little confusing verbiage, but what it means is simply that instead of, if you have a limit order on, and you say, I'm going to take, in Troy's example here, 10% profit target. Well, let's say in that 1 minute, it goes past the 10%, you would have gotten 11 or 12%. We will limit the profit to your actual target. And so that you won't get more than you would have realistically gotten, because your system, your brokerage would have taken your order off at your target generally. And this goes the same for loss. If you are very confident in your limit orders and in your particular platform and brokerage, and you do not think that you will go past your losses, except for the slippage, then you can also tag that box as well. No, non-opening simply means that, of course, overnight gaps risk is real. And so if the price opens the day way past your profit target or stop loss, then we will not limit it. You will take a larger profit or larger loss depending on the trade. And then three more fields. So the 2 consecutive hits thing is, if you've, again, especially this is applicable to, let's say, 3 or 4 legged trades, like ratio spreads, double calendars, condors, anything very complex. If you put these trades on and you watch them bounce around, anyone can know that sometimes you will get an erroneous mid price. And what this will simply require, the algorithm looks ahead. So if it will hit a profit target, if you have this checked, then it will look ahead to the next time interval, which is 1 minute now, and say, was this still profitable? So basically it's an extra degree of accuracy and tolerance to make sure that it wasn't a one-time erroneous price that you would not have actually gotten filled at. And the same thing for the stop loss. And then last, the min-max entry premium, if you are doing specific premium targeting. So in Troy's example for the condors, let's say you were wanting to get $1 to $2 premium, not more, not less, then you could enter those, $1, $2, and then it would skip any trades that were attempted to be opened that fall outside of that premium range. It would simply not do it. Let's say there's a day where volatility is too high or maybe too low, and or the strikes were not available at the proper strikes for you. Let's say that you were trying to do something way out of the money, 25 points wide, but there was only 50 points available. Well, your premium would be very different that day. And so this attempts to smooth that curve greatly. I think that's all the fields.
Yeah, thanks, Rusty. So we'll actually show that off here in just a second. But first off, if you look at this, we're doing the 16 delta put and the 10 wide. We're buying the put 10 points below. So let's run that real quick. And that is a loser for this year. So let's go back now and let's change that to a condor again and see what that would have looked like year to date. Okay, the condor is a winner year to date. Now, a couple things about that. A, we're very proud of the speed of that. What just happened in that few seconds is we're testing the market every minute since January. for this trade. You put 95 trades on. So we're going through that and very quickly. And so one of the things with backtesting is you want to be able to quickly iterate these strategies. And we believe we've set that up for you to be able to succeed in that. So this is a winner, opening up a 16 delta put spread and a 10 delta call spread. Now, what we want to test now is change that a little bit more. So instead of using delta, you can actually use percentage out of the money or a fixed premium. And I want to show you fixed premium real quick just to show you how that works. So I'm going to clear all these out and I'm going to add a put. We're going to sell a put. And in this put, we want to collect $1.50 for this put. And we're going to do it 10 days out. And we want to link that leg. And what that means is we want to buy a put and we want to do it 10 points away. This link leg, think of it as like a child leg. So like with a calendar where for those familiar with the calendar, what are you doing during a calendar? You're selling usually a front month contract and buying a longer dated contract. Well, that longer dated contract is usually going to be the same strike price as your shorter dated one. We don't know that when the test is run what those deltas are going to be. So when you link this, we say we're going to find this, whatever strike price this short is, and then we will buy the equivalent strike price 10 days out, in a calendar situation. And this one, this is just a 10-day spread. So we're collecting $1.50 for it, and we are going to do it 10 points out. Let's try that real quick. Okay, that one was a loser. But what's interesting about that, if you go through it, you're actually collecting a small amount of money because of the long in that case, right? You're not collecting, by the time it's all said and done, you're not collecting anywhere near $1. So let's test that again. But this time we're not going to link the leg. We are going to still collect $1.50, but we're going to add an independent leg at this point that we pay 50 cents for. So we should now collect $1 credit per spread. Oh, I did that wrong. Oh, from a capital standpoint, this one is actually tricky because as SPX, most of you know, that's a very big product. And so also I did 0 day to expiration, which would make sense. The margin said, wait, you're trying to sell something that's 10 days out and buy something that's 0 day. We're not going to run that. And that's one way we try to help you. So good catch, machine. 10 days to expiration. We're going to collect $1. Now let's run that and see. Oh, still did it. Rusty, am I missing something right here?
Troy, you need to allocate more of your
yeah, that's right. Yeah,
yeah. You need more than 10%.
Oh yeah, 10% of it. We're going to put 50% of our allocation. Good catch. Okay. So if you go through it, it is $1. We're collecting about $1 per trade, right? Pretty good. But there are some here where we're not collecting $1 per trade. We only get 85 cents, which is, real to life. But let's say for this purpose, we really only want to collect $1 per trade, or we're not going to do it at all. We're going to say $1 is the minimum. Now, if you go through that now, you'll see that we removed any of the 80-cent ones. We're only going to do this if it trades $1. So that's how that would work, is when you're doing fixed credit and you want to collect a certain amount, you can go through it and actually target it. And you might be thinking, man, that is a lot of buttons. That's pretty complex. Options are complex instruments, but what we've tried to do is make this simple for you to use over time. Once you get it, to where you can really build out with confidence your strategies. You can really hammer it, because any back test you can curve fit to make something look like you're a zillionaire. But what happens when you continually put real life stressors on it, like commissions and fees, like slippage? What would happen over time with that? So let's run a couple different ones again. We'll look at a couple different ones. So since 2018, there's been a couple winning strategies, and these are all vanilla. This is not curve fitting to this test. This is just running some standard strategies just to show you kind of how this works. So this is a butterfly, ran since 2018. It is buying a 50 delta. It's 15 days to expiration. You're buying the 63 long delta and the 35 long delta, and you're selling the meat. The meat is a 50 delta. You're selling two 50 delta calls. So this is a call debit butterfly. You're opening at 9:45, same thing. You're allocating 20% of your portfolio, and you're using one contract per trade. Now I'm going to show you in a second. We're going to change that just to show you how this, what would happen over time if you adjusted that. So, but with this one, you can see that this was a winner with one contract. In a similar way, you can look at double calendars. Double calendars have performed very well through time. A double calendar, think of it as a condor, but calendarized. So instead of the wings being the same expiration, you're kind of building two time spreads out in a way that you would with a condor. Similar situation though, you actually win 63% of the time. You're in the trade for an average of 3 days. And I'll show you one that's fun, just because this should be fun too sometimes, is let's do a 0 DTE spread. And again, most every other backtester in the world is not going to allow you to do this, but with 0 DTE becoming more and more of a thing, I think it's very useful to be able to test it. So this is ran since 2018, and you are selling a 5 delta call, or 5 delta put, and you're buying the wing 25 points away, and your stop loss is 300% of credit received. So you actually have a very high win rate here, and you win most of the time. Your losers are going to be much, much bigger than your winners. And this will be a good one to test some different things. So what we're going to do is we're going to take away the max contracts per trade, and we are going to say we're going to actually allocate our percentage. So we're going to start with 20% of our capital, and we want to continually put 20% of our capital in this and see what would happen. Now this one is running 4 years of data, so we give you an estimated time. It should run about 75 seconds. What it's going to do is it's going to go through and it's going to try to run, I imagine, around 700, 800 tests. Yeah. So this is since 2018, and your P&L, you won 79% of the time. Your P&L was around 5,900. And obviously, as your contracts get bigger, your losers and your winners get bigger. So I wanted to show you, as you go through time, you start with, let's see here, your allocation was 20%. So 20% allocation based on margin would be about 8 contracts to start out with. As you go through the years, though, you'll see that allocation changing how many contracts you're actually buying. So it fluctuates. Sometimes there's 7, sometimes there's 8, sometimes there's 6. If it's a losing strategy, you'll see it going less and less. If you're winning a small amount, then it's more and more. But over time, it fluctuates. Let's do it now, year to date, and see what would happen. So let's just run this the last 5.5 months and see what happened. So again, about 8 contracts per trade starting out with. It's one of my favorite ones to go through is quickly see how many contracts are adjusting, because that can largely tell me how good the strategy is or not. So the strategy is doing fine. It's continually using about the same amount of contracts. Let's adjust this a little bit more. let's add, we're going to sell a call. And since calls are a little bit different than puts, we're going to sell a 10 delta call. And we're going to buy the wing 25 points out, 0 days to expiration. Let's run that and see what happens. Okay, we start, condors are doing better. Imagine that in this world right now, selling calls. It seems to be doing well. So you win 82% of the time. And to show you that contract thing I'm talking about, as we go through time, you're using more and more of contracts. Again, you're not going crazy. You're using a small amount of your percentage, but your contracts are going up because of the allocation. So one of the fun things about this you can do is you can say, well, if I have this winner, what are you tempted to do? If you have $100,000 capital starting out and you find this winner that wins 82% of the time, I bet this thing is going to send me to the moon. I bet it's going to make me a billionaire. Let's put 50% of our capital in this trade. Side note, don't do that. But theoretically, you can see what will happen. 50% of your capital in a 0-day trade theoretically works pretty well this year. And as you can see, the contracts continue to go up through time. You're now using, by the time it's said and done, 60 contracts for this. Let's do that again and say we want to take 100% of our trade. Again, foolish, don't do that. You would have doubled, right? But here's the problem. And this is why it's important to never do that, but it gives you some real life reasons to not do that. Let's say this losing trade was the first one, right? That's the second one, and you have a string of winners. But if you're only winning 82% of the time, it's not out of question at all that you would have 4 or 5 losers in a row. That's completely within statistical probability. Well, if you're allocating 100% to anything, as you all know, and you lose roughly 24,000 a trade, and you start with 100, you're about 4.5 trades from bankruptcy, right? So we allow you to we show you that just to say, you know, what would happen, what would be the theoretical things that you could do with it, but also the dangers of it as well. So what I'll show you now is something that we just added that we think is kind of a game changer in it, and that most people are not running one strategy. They're running multiple strategies. And most backtesters are not going to allow you to see those strategies put together, but we have created a way called portfolios to do that. So what we're going to do is I've created this portfolio, and it's all these tests. Again, these tests run through time, where we've combined them and shown you what would happen, right? So here's your portfolio, and here's the underlying SPX. And this is a loser, and that's not okay for Wealth and Joy. So we're going to change this. And I'll show you how to change it in just a second. But the quick numbers on this, we give you in a portfolio view the CAGR, compound annual growth rate. We give you your P&L, your dates run, your max drawdown, your starting ending capital again, and your maximum in funds. And then we give you some annualized metrics. So your max drawdown versus SPX max drawdown, your gain versus SPX. But again, this is loser, and that's not okay. So let's adjust this a little bit. And when you create a portfolio, what you're going to do is you're going to pick the starting funds that you have, the date that you want to run this portfolio, and you can click through and add or remove tests from this. And then all of these are capped at 1 contract, as I showed you earlier. But if you did not have that cap on, we would apply an allocation to it. So you could allocate different percentages to it. Let's see how to adjust this. Well, there's one loser, we know, through time. So let's take that off. And again, this is run year to date. So it's going to be different P&Ls than these individualized tests. And that's the nice thing about it. You can take tests that have been run 4 or 5 years, and you can say, well, take that strategy and run it for the last 6 months with these other strategies, and how would that work? So let's run that real quick, taking the ironfly, the losing ironfly off, and see what would have happened. Okay, well, that greatly improved it. So it looks like the ironfly has not done well this year to date. But we can probably do better. So let's continue to go through that. And what we're going to do is change one of our strategies and run this again. So our portfolio view shows you which strategies that you're running and the allocation that you have towards it. And you can click through it and actually go to that strategy and change something if you want. So with this 0-day strategy, I want to actually go back in and make it that condor that was very, very profitable. So we're going to sell the 10 delta and buy 25 points out. Let's run that again. And again, we're going through time stamping those trades, marking them down, keeping up with them, and then recording historically what would have happened through time when you put each of these trades on with the parameters that you set. So over time, you won 78% of the time. And we're going to replace this test. So we had a 0-day strategy before we had saved, and it was just a put spread, but now we're going to replace it and add those new parameters. So now we're going to go back to portfolio, and I want to run this year to date again, but I want to take off the ironfly, and I want to run the 0-day strategy. Let's see what would happen. And again, as it's running, this one is taking all of your strategies. There we go. So making that one change on the strategy has brought our portfolio to a profitable result. So what I want to do is save this portfolio, the winning one. And what we show you here in the portfolio view is a daily log of all your profits, all your funds, and go through the list of your current funds. So you had a drawdown early on this year, and it looks like since about March, you've been profitable. So that's a quick way to look at current funds and net liquidity to see how the total portfolio is doing. Again, we show you each one of the strategies that you can click on and edit. And then we give you a trade log like we do with each test, but for the entire portfolio. So this is everything that you put on through time. So you can see the profit and loss when you got stopped out and things like that. So that's a very quick overview, but hopefully it gives you some idea of the capability of what we're trying to accomplish with it so that you can build out strategies with confidence and then look through history to see in different volatility environments, different type of price regimes, how things would have performed so that you can create better models. That's what we're really trying to do. So with that, do you have any questions? Or are there any questions for us?
Great, Troy. Thanks for the very wonderful walkthrough of OptionOmega. I think for option traders, for beginners, it may be a little overwhelming, but not to worry. This this webinar is recorded, so you can always review what's going on. And I can assure you, if you trade options for a while and you want to, if you're ever wondering whether your option strategy is going to perform well in the future, you're going to first need to check whether it has performed well in the past. Because if it doesn't, not that the past will guarantee the future, but if it doesn't even work in the past, what makes a trader think that it's going to work in the future, right? So just now, Troy have demonstrated to us that we can test almost any strategy in just a few clicks, no programming, and perform hundreds of tests from 2013 January 1st all the way to the latest date, and in a matter of seconds or minutes. Now, if we were to use, let's say before OptionOmega, I was trying out think of swim on demand. Anyone who tried using that to do any form of backtesting will be shocked, right? Will be in for a rude shock that how slow it can be. Okay, so now that Troy has demonstrated OptionOmega, if you have any questions for Troy or Rusty or how to anything at all about OptionOmega, please type into the chat box that you see on the bottom right of the screen if you're using a desktop computer. And if you are watching us on YouTube and then you can't come inside the webinar room, please go to the webinar link and use a different email address to register, and you will be able to enter the webinar room to ask your question. Okay, so please go ahead and type in your questions. So meanwhile, Troy, I have some questions myself, so I will kickstart the process. Okay, so firstly, all the metrics, the performance metrics of the test, as well as in the portfolio tab, or are they also using the 1 minute data? For example, the drawdown, the CAGR, all those numbers, are they also using 1 minute data?
We just launched 1 minute data this week, and Rusty is our chief software architect. So I'm going to let him take all hard questions, and I will take easy questions. So with that, Rusty.
Okay, Rusty.
Yes,
All in your
thankfully, yes, sorry, the portfolio view uses the same resolution on the data. So yes, 1 minute data for everything. So when you saw Troy run 5 different strategies over a year and it completed in, I think, 15 seconds, that is using 1 minute data, correct, with all the metrics and everything else built in.
Right. So the metric, Troy, may I trouble you to hop over to the portfolio tab?
Sure.
And then click on one of them. Yeah. So Rusty, so you're saying that the P&L, the CAGR, the max drawdown are all based on 1 minute data intraday?
That is correct. And so the P&L is your yearly P&L, but that's based upon all the trades that are executed with stop outs, profit takes, everything on 1 minute time frame. Same thing with CAGR. So the CAGR is based on realized profits and not on net liquidity, but the max drawdown is based upon end of day net liquidity. So the point is that we look at the end of the day, all the trades that were on and off, and say per day, what was your gain or loss that day? So that's a little bit tricky in terms of you wouldn't see an intraday drawdown per se in that one statistic, because we're comparing with, so if you go to the daily log, Troy, it's basically this level of granularity. So you're simply saying at the end of the day, what was my drawdown? So that's the only part of the system that is not 1 minute, and that is the drawdown number itself. But everything else is based upon 1 minute. Does that make sense?
Yes.
Because net liquidity is people usually want to know at the end of the day, how much money do I have in my account? What's my liquidity in my account? So even if the trades are still open, but you have a really bad day, like in March of 2020, and you were selling, let's say, naked premium, then what would be your drawdowns at the end of the day?
Right, got it. Okay, good. So thanks, Rusty. Okay, so let's go back to the test tab, Troy, and let's go into any one of the tests.
Okay.
Yep. Okay. So for the metrics here, it's also based on the 1 minute data.
Correct.
Rusty? Yep. Okay. Good.
That is correct. Yeah.
That is very, very amazing, because comparing, I have traded 0DTE for 1 year, and I know how wild the swing can be intraday. So so if a backtester cannot do intraday data, I think it's not as accurate compared to what OptionOmega is offering. So it's really, I'm really thankful to you guys to bring it to the world. Yeah.
Well,
so next thing inside this table, inside the backtest view, I see a little icon that seems to be able to download the log. Is that correct? On the right hand side?
That's correct. Yeah. So we will export to CSV for you. So you can a lot of people use this and then post-process it using their own models. They want to add some stuff to it. So you can export this to CSV and then open it up as a in tab format, so you can go through it. So we give you a way just to basically post-process it or look at it in a different way.
Right. So you can export the trade log. It
That's
is a
right.
trade log, right? So if let's say you want to selectively do some post-processing, like do your own analysis, you could do that. Okay,
That's exactly right.
wonderful. That's wonderful. Okay. So let me see. Now, may I trouble you to so-called start a new click on the back test.
Sure.
Yeah, new. Yeah, that's right. That's right. Yes. Okay. So let me see. Now, I think maybe we'll take this opportunity to expand a little bit on how the lakes are constructed. Right.
Okay.
So because here, this is where one of the great feature of OptionOmega, where you can totally construct whatever creature you want, be it a fly or a condor, or iron, or I don't know, water vapor or whatever. So you can construct anything here, right? Lizards also maybe. So butterflies. So maybe we can walk through that. You have some defaults, right? You have common strategies. Maybe you can delete all the lakes first. Try. Whoops. Troy's gone.
Can you see me or can you hear
Yes,
me?
Rusty, you're still here. It's
Okay.
just
Let
Troy.
me go ahead and I will take over.
Okay.
That's okay.
No problem.
Can you see my screen?
Okay, just a second. Yes, I see your screen.
Okay.
Okay,
So,
wonderful. Yep. So I was just hoping to go through this. I think this page is one of the most important page, because this is where the trader will be constructing their strategy without programming, right? And it's
correct.
totally
Correct.
flexible, that a person can choose whatever strategy, and then how the legs are constructed. Of course, if a person is just trading long calls and long puts, or short calls and short puts, then it's very simple, just one leg. But if
That's
for the
right.
advanced traders who are trading like butterflies or ratios or back ratios, or I even see the jade lizard there, right? So
It is.
so
We
there are
do have a jade lizard. Yes.
yeah. So there are multiple legs. Hey Troy, you're back.
Sorry about that. My internet went out there for a second.
Yep. So do you want Troy to take back, or
Rusty can drive if he has it. That's perfect.
all right?
Okay.
So
Sure. Yeah, go ahead. What would you like me to do?
yep. So maybe we can just explain a little bit on how the legs can be constructed. Let's use let's say, for example, just now Troy was using an iron condor, right?
Correct.
Yep. So I think that's a pretty common strategy. So the iron condor typical. So what you see here is that you can use the delta as a way to choose the legs, right? The short
That
legs,
is correct.
right?
The short legs.
So
Yes.
that's right. So in this case, your short put is using delta 16, and your short call is using delta 10. Okay.
Correct.
And then you have the link legs. That's why the link icon is green. The chain icon is green. So what that means is that the buy put leg is linked to the short put leg, and the distance between the leg is 10 points wide.
Right.
Correct. So this is a very important thing. So similarly, for the short call, sell call leg, which is a delta 10, whatever strike price it is at, and then it has a wing, a link leg of buy call that is 10 points away, so that both the wing width are 10 in this particular case. Correct? Yeah. Okay. Now, can we also define, let's say we want to do a short strangle, but we just don't do a very cheap wing to cut the margin requirement. Can we do that?
Okay.
That means we have the long call that is by price or by a very small delta.
So you could, let's do that by delta then. So if you add a leg, I would not do link. So the easiest way to construct this is probably you would then buy a put, and you could choose 5 delta. Let's say you choose 1 delta. You would want to make the DTEs the same. And then you could add a long call to match your call that is, let's say, also 1 delta 30 DTE. So now everything's on the same expiration. This is very important. I often forget to check that and make an accidental calendar, which you don't want to do. But this would be something, this is a strangle with 25 delta shorts and very cheap 1 delta longs.
Right. So I think this is a very important point, so that the trader can know that the iron condor, so to speak, can not only be defined by the width of the wings. The width of the wings can also be defined by using delta. Right,
that is
which
correct.
is in this case, yeah. So this is great, yeah, because sometimes a person want to sell a strangle, but they just want to do a small wing to reduce the margin requirement.
Correct.
Right. Okay. Wonderful. So likewise, if a person want to do ratio spreads and so on, if I want to do I think I will not ask further questions on this section. So in short, a person can define many legs in whatever configuration they want, and then backtest that. Right? Is there a maximum number of legs that I can add to this? 4? Is it 4?
Right now it's 4. Yes.
Okay. Understand. Now let's move on to the next section of this backtest page. Okay, entry time, right? So what is the earliest entry time we can use, and what is the last entry time we can use?
So thankfully we'll tell you. So this is all Eastern time, U.S. Eastern time zone, but 9:32 to 3:59 p.m. So 2 minutes after the market opens, and 1 minute before it closes for the day.
Right. Maybe you can share with our audience, why do you not start at 9:30 and end at 3:59?
So since this is 1 minute data, and I believe the snapshot is taken at the beginning of that 1 minute candle. So at 9:30 there are no option prices, right? Since the market is just opening. So the first data available is 9:31. And the prices at 9:31 are so wild and erroneous that I do not recommend that. We have found them to be so bad and the fills to be so terrible that it is not useful from a backtesting standpoint 1 minute after the market opens. So 9:32 represents essentially the second opening candle in 1 minute candles that is available to you. And I find that even 9:32 would be pretty risky in terms of realistic fills. You might get some really wide bid-ask spreads. The market can be pretty illiquid at that point in time. And so usually I like to wait till 9:45, but again, you could do 9:32. And the same with 4 o'clock, right when the market is closing. At 4 o'clock, the market's closed. And so at the beginning of that candle, there are no prices per se. It was just whatever the last candle was. And so you will get, and if anyone who's ever traded longer duration strategies, there are times your brokerage will show you a really weird price, midpoint price on your spreads at the end of the day, which are not realistic. And so again, since this is about realism and accuracy, 4 o'clock is not a good time to enter a trade either.
Yes, I totally agree with you, Rusty. So if any of us have positions on in the options, and we look at it when the market is closed, that price cannot be trusted, right?
No, never.
Yep. So that's why having this precision of controlling time is a very useful thing. It gives us a more accurate backtest performance.
Yes.
Yep. Okay, so let's go on. So here, the frequency. Now, maybe you can share with us a little bit on how this frequency works.
Yes. So there's
So
the
daily
daily
means
frequency.
that we can open every day, right?
Yes, every day that these conditions are available, and that's kind of important. So let's say this was if I made this a 0 DTE trade, so now this is not as relevant because 0 days or 5 days a week for SPX. But in the past, 0 day was Monday, Wednesday, Friday, and before that even it was Fridays only. And so if you were to select 0 DTE and use exact DTE, then it will do it daily, but only when there are 0 DTE options available on the chain that day, and when also any of these entry conditions below are met properly. But it will attempt at 9:45 daily to open a trade. Conversely, you could say, I want to do weekly, different days a week. So let's say you love putting on a trade on Tuesday. Let's say you sell calendars on Tuesdays and Thursdays. You can do that. Or some people like to, for example, you have the monthly OPEX, which is this Friday, for example. And so it is always the third Friday. So maybe you want to try to front run OPEX, which again is just when it's a big expiration for the options chain. And so price often moves a lot before that, like yesterday, like today. So you could say every third Wednesday, I want to buy puts, So there's a lot of flexibility with different kinds of strategies and what you could do.
Understand. Now, on the toggle of using exact DTE, when it's toggle on, it's quite clear what it's going to do, right? It's going to try and
Correct.
find the option chain with the exact expiration date. But when it's toggle off, what do you do? What in the back end? The
Yes.
next furthest away, or
That is
is the
correct.
nearest? The
It's
next furthest away.
the next furthest away. Yes, we will never do closer because I feel like that is dangerous. It's always the next furthest. But
Right.
perhaps we will change that in the future.
Right. Understand. Okay. Got it. And let's go on a little lower. Now, in terms of maybe we can share with us a little bit on how this VIX part works. Maybe you just turn on the VIX toggle. Yep. So min VIX and max VIX. And here, ladies and gentlemen, we are at the entry section, right? So we'll be looking at what condition will we enter the trade for whatever strategy that's defined, all the legs that are defined on top. So here you're saying that in addition to the DTE, to the allocation and the max open trades, that kind of constraints, you can further add in the requirement where there is a minimum VIX and maximum VIX required. So maybe you want to sell premium only when it's high VIX. So maybe when
that is correct.
So you put something like what, 30 and 99.
Yes, but the max is optional. So if you just wanted to do above 30, then you would only have to enter a 30 and nothing for the max.
Okay, understand. So conversely, if I want to do a debit trade, I want to buy when it's cheap. So I want to buy only when it's low VIX. So I just fill in the max VIX.
That is correct. So let's say under 15, which has been a long time since we've been under 15.
Yep, understand. Okay, so that's how this VIX toggle works. So maybe we can toggle off that and move on to the technicals. Yep. Okay, technical indicator. So right now you have two technical indicators that we can use to constrain, that we can use as condition for entry, right? So the first one is the RSI. So so maybe we want to only enter the trade when RSI is in the overbought area. So it'll be above 70, for example, right? So it'll be
that is correct.
70.
Yes.
Okay, so max, well, is an oscillator, so it'll be 100. And then or we want to put it in, let's say we only want to do it when it's near 50. So we can say 40 to 60, for example, right?
Yes.
Yep. So
in a very stable environment. Yes.
Right. Got it. So for the RSI, you're using a daily time frame to calculate on a minute basis. Is that correct?
Yes, it's a 14-day RSI using a simple smoothing algorithm. And it is updated every 1 minute. So the last data point in a 14-day RSI is the current day, and that current day is the underlying price that is on that 1 minute candle.
Right, that is developing, because current day is still developing.
Yes.
So every minute you will calculate that same day's RSI 14-day period, right?
Yes.
Right, and then see whether it is within this range. Now that number that you input, is it greater than and equal to, or is greater than?
Greater than and equal to, yes.
Okay, and
or
less than and equal to, right?
Correct.
Okay, understand. Okay, RSI cleared. Thank you. And next one is the SMA entry. So let's have a look. What do you have there? None, below SMA, above, and compare. Right. So let's say
Yes.
we want to do. We only want to enter when it is above a certain SMA. So let's do that. And then what are the options available? Okay, 20, 50, 100, 200. So these are the common SMAs.
Yes.
Yep,
And
got it.
by the way, we are also looking to add SMAs 1 through 10 days for more shorter duration trades. It's something
Right.
that is on our list that we want to do.
Okay, wonderful. I think that would be great for shorter term trades. Yes. Okay, and then you have a crossover inside the entry option.
That is correct.
Okay, so that's something like golden cross and death cross, right?
Yes. Yes. So I forget which one is which, but if let's
Yep.
say the
Let's say 20 over 50 over 200.
Yes.
So that's the
So
Mhm.
something like that, yeah, or vice versa, right? So if you had the 200 was above the 20, right? That would be a very
bearish.
yeah, that would
Oh,
be
no, yeah,
bearish.
that's right,
For
bearish.
example.
Yeah.
Yeah.
Okay. So you wanna. So this is these are the additional few conditions that trader can have to define the entry criteria. Great,
Correct.
thank you. Got it. So the next one, wow, squeeze metrics. This is new to me.
So this is there's a service called Squeeze Metrics that makes their data available. I have the website here. They have a nightly download that anybody can look at, and a website where you can see the current the end of day value. But what these values are is this one. There's 3 values, and briefly, this is a dark pool index, which is, if anyone is familiar with off exchange trading, dark pools, this will tell you how much is buying versus selling in a percentage. So the DIX, the dark pool index, if it is, say, above 45, above 50, you can look at some of the historic values and say, are people buying right now or are people selling right now off exchange? And this is usually institutional money or market maker money, right? These are large volumes. And so that is that. And then the GEX is, again, this is a theory based on that whenever somebody buys an option from a dealer or a market maker, however you want to phrase that, on the other side of that, those market makers are required to hedge those positions by usually buying and selling futures, for example, and doing other things. And so this will tell you what the current exposure of the market is. This tells us if we're in a what they call a large negative or positive gamma environment. And again, this can tell you, basically this is correlated, and he has put out white papers on all these things. If you go to the website at Squeeze Metrics, he has very in-depth white papers about how the larger the negative gamma exposure is of the market makers, the more volatile the market is. So it's sort of a forward-looking indicator similar to VIX. And then GVX is simply the GEX value translated, or GXV, sorry, translated into a one-day volatility similar to VIX. So this is in the billions, this number here. So you would enter something like 2 billion as a minimum. This number is more like 16, 20, or 31, I think is the current VIX. It's something similar to that. So these are very advanced metrics here that are available that we added.
Right. Thank you. Okay. I definitely don't know what they are. We'll have to read out on them. But thanks for including it. It gives us
Yeah.
an additional, hopefully, edge to do
Yes.
our strategies, right? After we learn how to use them. Okay, so we have completed the entry section of how we can use clicks to define our strategy as well as condition for the entry. For the exits, let's take a look at the exit section. So we have the profit target and the stop loss. Now they are not
Yes.
required fields, right?
They are not. No, if you either one of them is optional or required, but you could simply put on a trade and let it expire every time.
Right. Now, for the attendees, if you have questions, please feel free to type into the chat box based on what I have just asked Rusty and Troy. So let's go on to, while I continue to ask them, you can accumulate the questions there and I'll ask Troy and Rusty all in one go at the end, okay? So for the exit condition, so the profit target is optional because if we are selling, we might want to hold it to expiration. So we
Correct.
won't have a profit target, right? Or we just either hold it to expiration to keep all the premium collected, or we max loss, right? So that's why the stop loss is also not required. But if it's entered, it will be used.
That is correct.
Okay, got it. So exit at DTE. So how does that work?
And so this one, if you had a longer duration trade, so if we go back up to here, let's say, for example, we were doing, well, Troy had a 10 DTE earlier. So let's make this 10 DTE again. So if you have a 10 DTE trade, let's say that you don't want it open, you don't want to wait till the very end. At most, you want to leave it on for a week. So you would exit at 3 DTE. And what that would do is that when there are 3 days left to expiration on the closest of them, so if you had something that was a calendar with different expirations, you would use the closest. It will try to exit the trade at the end of the day at 3:59 p.m. You can also, so that's what that is, and then additionally you can say, well, exit at noon though, because I don't want to wait till the end of the day. And this is also optional, so you can have just this. So let's say you're doing 0 DTE trades. This is very powerful. You could enter a 0 DTE trade at 9:45 and exit at noon. And so you're only trading for a few hours every day. That's an option.
Right. Wow, very powerful combinations that a trader can have to define their strategies and backtest them. So we here for exit conditions, we can also exit based on VIX, right?
Yes.
So in a similar way. Okay. So and then technicals, just like the same thing as the entry. So we won't go through that. So what's the third toggle there? Exit when out of the money short.
Yes. Oh, sorry. Go ahead.
Go ahead. Yeah. How does this work?
So this is if you are selling something like what we have right above, right, with the condor, then what you're going to do is when an out of the money short goes into the money, exit. Some people call this tested, right? If the short leg is tested is another way to say this. Again, this is only useful for certain strategies. If you're doing an at the money strategy, such as an iron fly or an at the money calendar, obviously not useful because the short leg is already in, at the money or in the money. But if you are selling spreads, condors, or naked premium, then this is a very useful thing to say. Maybe instead of a stop loss, you always get out when the leg is tested.
Right. So if multiple of these conditions are entered, these fields are filled up. So whenever one of them is fulfilled, you will exit. Correct?
Correct.
Okay.
So if you've had those 3 on, every 1 minute we check all of the conditions, and if any of them are true, then we exit.
Right. So when you exit or enter when the condition is met, you enter or exit at the opening of the next 1 minute bar, or at the same bar?
At the current bar. Yes.
Okay. And at the mid of the BNRs?
It is at the mid unless you use slippage. And then the slippage would adjust the mid price.
Right. understand. Wow, got it. Okay, let's move on to the miscellaneous section. Just now you have already explained, I think, all of them. So yes, you have explained all of them. So wonderful. So we have covered this very important page. So as you can see for the attendees who are with us, to do a back test, all you need to do is just click and define your strategy, your entry, your exit conditions, your entry conditions, and some very specific ways that you can, under the miscellaneous tab, to define your trade plan, so to speak. And then just click run, and then OptionOmega will do all the hard work, whether it's 10 tests or 100 tests or 1,000 tests, it will just do it. Usually in a matter of seconds or minutes.
Yes.
Right. Okay, good. And then if for those who are really who wants the statistics beyond what OptionOmega has provided, then you can export the trade log to do your analysis yourself. Correct?
That
Yep.
is correct.
Okay,
Yes.
wonderful. So
Sorry.
that's all the questions I have. So let me now look at what are the questions that the attendees have posted. Okay, so let me see. Now, Mingfa have asked, any ETA for RUT support or the additional symbols?
So we are working with our data vendor right now for IWM and QQQ, and I know that that IWM and RUT are different. RUT is closer to SPX. The problem with RUT, we may eventually add it. The problem is that the liquidity is low, and so backtesting is more problematic than IWM, which has much higher liquidity. Perhaps, so I don't have an ETA on RUT, but IWM and QQQ hopefully by the end of the month is our hope. But again, since we have no control over some of the timeline on that because of waiting on certain pieces of data from our data vendor, which is obviously a very large volume of data. So.
Yes, definitely. Yep. Okay, Mingfa, I hope that answers your question. So if a person want to do RUT strategies, can they use IWM as a proxy first?
Yes, I would recommend that.
Right, got it. Okay, next question comes from Tan, and Tan is asking, let me see, is there an exit rule for DTE? I think that has been answered because in the exit section,
Yes,
there is an exit rule for it, right?
that is correct.
Okay. So next question is also from Tan. Can we manage the put and call legs separately in a complex strategy? Okay, I think what he meant is this. So yes, you can define the strategy using the legs, up to 4 legs. And then,
But I think if you wanted to do separate stops, though,
mhm,
what I would recommend doing is do 2 different strategies. Because what you would be doing then is leaving one side on potentially. And so what I would do is I would do if you have 2 different spreads, I would do a short call spread, right, with a certain percent stop out, and I would run that, and then I would do the put spread. Make sure you make that negative, and then run that with the same stop out, and then combine them in a portfolio view to see how they would do over time.
right, understand. So it's 2 separate tests and then combine them using the portfolio feature. Very
Correct.
smart, very useful. Okay, Tan, I hope that answers your question. The next question comes from Fabian. Fabian is asking, where does OptionOmega's data come from? Is it from the exchange?
Yes, we do get it from an OPRA, what's called an OPRA data vendor. So OPRA is option price. I forget what the R is. Authority. I should probably know that. But
option price reporting authority.
Thanks, Troy. And so there are a number of OPRA data vendors. We were not contractually, we will not say which one it is, but basically CBOE, iVolatility, there's a number of them. They're all from the same. OPRA is actually all of them. It's like a giant terminal feed that's very intense. And so we do use a verified OPRA data vendor for our data. These values are not calculated from the underlying, but they're actual option prices at that time and that date, So, and we have the delta as well. The delta is given to us. We don't calculate the delta either. So all those things were real values on that date and time.
Right. I think that's very important, right? So because the data is not calculated, it's real data that we see from the exchange, from the broker, as if we were trading on that day, that minute, right? So
Correct.
I think that
Yes.
yes. So thanks, Rusty. So that also links into the last question that we have, which is from Matthias, because he was asking whether the option prices or the option data is calculated, or are they real option market prices and data. So to answer your question, Matthias, it is the real option market prices and data.
I was just going to say with that, I mean, you could theoretically, and I've seen this before, backtest options using only the Black-Scholes formula. So you could theoretically plug a delta in, plug a leg in, and use math to calculate it. The problem is anyone who's traded options for 5 seconds knows that the Black-Scholes formula is a theory that holds true largely, but in events, there's a lag in that theory. And your profit or loss comes from the lag. That's how options trading works. And so if you've ever ran a tail hedging strategy, tail hedging just simply meaning, a tail of a distribution curve, most people would say that those strategies are losers in the long run, but Black-Scholes would largely say that's a loser in the long run. But distribution laws get wonky when human psychology gets wonky. Saying all that to say, this is real data. Black-Scholes formula, you could theoretically do it, but we don't trust that ourselves. We wouldn't trade that ourselves. The mix of theory and practice is very important to us. So.
Yes, got it, Troy. And I agree with you, because numbers that are generated can be very different from what actually happened. Right? So this is the true mark of real option traders, not just coders trying to trade. Okay, these are traders who happen to be coders who created this excellent piece of art to help all option traders around the world to backtest, to build confidence in their strategies, perhaps also even to refine their existing strategies using as close to actual market data as possible, right?
Yes.
Yes.
And to that point, one thing I would like to emphasize is because, let's say some of these are such quick tests to run, you can simulate hundreds of trades, years of trades. Like Troy was saying, one of the advantages is if you have a good strategy, let me rerun it and let the system simulate hundreds or thousands of trades in a few seconds and say, what would it do now with 30% stop loss? What about 40%? What about 50%? And you can do that with such speed and accuracy that I think is very helpful for a lot of people.
Yes. Why should we use like 20% target? Why not 25? Why not 30, right?
Right.
Yeah. How about stop loss? Are we prematurely stopping out, or should we give it more leeway to swing around? So at clicks, just a few clicks, and within seconds or minutes, hundreds of tests is done. I think that adds gazillion to the productivity of a trader than to try and do this manually. I think it's impossible to do this manually.
Yes.
We'll be too old. Yeah. Right. Many option traders are, our age group, right? So we
right.
need technology like this to help speed things up for us and
That's
do
right.
it
We're running short
accurately.
on time.
Yep.
Yeah.
Now, Rusty, maybe this question should be posted to you. If I specify a delta for a particular leg, right? So and then sometimes multiple strikes will have the same delta. So how will you choose the strike?
Well, first of all, the deltas are actually in decimals, up to 2 decimal places. So a lot of times your brokerage won't show you that, but our underlying data that we get from the data vendor. It's not 50, it would be like 49 point something. So it will find with a high degree of accuracy what's closest to that. But if there were two with the exact same, then it finds the strike that is closest to the current underlying price. So example, today, if you were trying to do a 5 delta, 0 day, let's say 3800 and 3805 were both 5 delta, it would choose 3805 since it's closest to the current price, assuming the market hasn't crashed while we were doing this demonstration.
Right, understand. Yep, market just opened 5 minutes ago. So you choose the nearer the money delta, right? So, right, if there
That
are
is
two,
correct.
let's say it's 10 point, let's say delta 5, then there's one delta 5.1, 5.5. So you choose the delta 5.1 because that's nearer the money.
That is correct.
Okay, choose the nearer money. Okay, got it. So let me see. There's another question that came in. Okay, okay, Tan is asking the margin allocation percentage. Is it based on buying power or how is it calculated?
It is. We do our best to calculate the margin requirement, the buying power that you have. So we look at your current funds when the trade is executed, because your funds are increasing through time. And so let's say you started with 50,000, but now you're up to 100,000 a few years in, and you allocate 40%. We do our best. And so for all of these out of the box strategies, I have done the work to calculate the margin requirement. And they do, I will say this, it varies slightly from brokerage to brokerage. I use Tastyworks margin requirement calculations for these. And this is using what's called Reg T margin requirements. So portfolio margin, if you have enough in your account, is slightly different and would be almost impossible for the system to calculate, because that varies if you have long positions and all kinds of things. So it is a best guess at the margin requirements for known stuff. Now, if you do something different, like a 1-1-1 strategy, which I know is more popular now, where you're doing a call and buying a put and selling two and things like that, it would be more difficult for the system to calculate that. So it will default to just one contract when the system cannot figure out, because there are infinite strategies, so it's difficult. So I hope that answers the question.
Right, got it. So it's based on Reg T. Tan, it's based
Yes.
on Reg T calculations, not portfolio margin, because portfolio margin takes into consideration many things, and it's not possible to calculate it by us because the broker can expand and contract the margin requirements depending on the kind of trades you have in your account. So Reg T way of calculating is easier. And then if so that I hope that answers your question, Tan. Yes, okay, yes, he said understand, thanks, great. Okay, so the next question comes from Michael, and perhaps the most important question for tonight. How much? And what's the special offer for our attendees?
So the special offer for your attendees, the price, it's 50% discount, and that will make the price either $50 a month if you sign up monthly, or only $300 per the entire year if you sign up with an annual subscription.
Right, wonderful. So how can the attendees sign up and get the 50% discount?
If you
Troy?
want, I can post it. I can post it in the chat, the link.
Okay, you can post it in the chat.
Yeah, there you go. That link will take it to registration. You can register, and yeah, normally the website price is $100 per month or $600 a year, but for those with that link, you get 50% off your first year. So it'd be $300 for the first year, $50 per month, like Rusty said.
Right, and then is there any lock-in period? Can they cancel anytime?
Yeah, they can cancel anytime.
Right. Okay. Wonderful. So the link Troy has posted into the chat box. But for those of you attending who who finds that the font size might be too small, it is basically the optionomega.com/register/wealth and joy. Okay, so if you use that link to register for your account, then you can get 50% discount off your first year subscription. So if you go by the monthly plan, then it'll be 50% off the monthly price. And then if you use the annual plan, then it'll be 50% off the annual price. So the price for the monthly plan is how much again? Sorry. $50.
It's $50 a month. Yes,
Mhm.
a month, or $300 per year, which comes out to what, $25 a month.
Right. Okay, wonderful. Got it. So I will now this webinar is being recorded. So if any of you wants to revisit the details of what Troy and Rusty have shared with us, so please go ahead and watch it on our YouTube. And if you're watching us on YouTube, please don't forget to subscribe to our channel and give it a like. And also, if you have other friends who are seriously trading options, please share with them the wonderful tool that Troy and Rusty and their partner have built, OptionOmega, and grab this deal for 50% off, right? So Troy and Rusty, we have come to the end of our webinar today. Let me just do a final check. Okay, no more questions. So if there's no more questions, then what if the attendees want to get in touch with you guys for support or for questions? So what is the usual mode that they can use? Is it a Discord server?
That's a good time to share. Let me actually share my screen again. And if you look on the website here, tell me if you can see that. So at the top here,
another few seconds. Okay, the website has loaded.
Okay, sorry about that. So there is a Discord server which you can join here using this button. We have a Facebook group. This is our Twitter feed, and then we have a YouTube channel as well. And you can see that's what the documentation link is actually just a bunch of it is a bunch of YouTube videos that our partners have put together that are very informative and go into more depth into some of the individual features if you'd like to watch some of the videos. But Discord and Facebook, we're both very active on.
Right. So in the Discord channel, in the Discord server, there'll be different channels for public as well as for subscribers, right? So then that's where all the subscribers will be there to ask, and we can learn from each other as well.
That is correct.
Okay, cool. Wonderful. So we've come to the end of the webinar. Thank you, Rusty and Troy, for sharing with us this wonderful tool and for bringing to us this wonderful tool as well, right? So all the best to your future endeavors. Do you have any last words to share with our attendees?
Thank you just so much for having us. It was a pleasure, and I really appreciate what you guys are doing. And so, yeah, thank you so much for having us.
No problem. Thanks again for your time. All right. So all the best to you, and I'll see you again. Perhaps also hang around the Discord server. Okay. And for the rest of the attendees, thank you for your time as well. So don't forget to take up this very special offer from Rusty and Troy and their partners from OptionOmega. And good night or good morning, depending on where you are from. And I'll see you at the next webinar. Bye-bye.
Bye.